Welcome to The Investor, a podcast where I, Joel Palafinkel, your host, dives deep into the minds of the world's most influential institutional investors. In each episode, we sit down with an investor to hear about their journeys and how global markets are driving capital allocation. So join us on this journey as we explore these insights. All right, so super excited today. I'm here with Eduardo. He's one of the GPs at Mosaic ETA, and we're going to talk about something different today. We're going to talk about entrepreneurship through acquisition. We've had all different types of asset managers on this show. This is the Investor Podcast with Joel Palafinkel. We've had real estate investors, we've had hedge funds, we've had award-winning private equity funds. So just excited to kind of go a little deeper on ETA. Before I do that, I want to introduce our guest. It's Eduardo Zaldivar. He's a co-founder of the fund, and just really amazing background. Spent time at Stanford doing his MBA, and then Harvard Kennedy School, and then Texas A&M. So excited to have you on, Edward, and learn a little more about your story and kind of where you've arrived and, that journey that's gone, that's taken you there. So why don't you start with just kind of your early childhood and kind of what you focused on in your early years of education. And maybe what I always like to ask is what you thought you would be doing. When I grew up, I just thought I would be doing engineering and tech because that's kind of what my family pushed me to do. And a lot of my relatives and my older cousins were in that space, getting an engineering degree, getting a job, working in tech or software. But I'm curious kind of what you thought where your career would be heading and excited to kind of learn all the little pieces of the story that got you to where you are now.
Well, Joel, really appreciate you having me on. And let me first say it's an honor to be here. And I just love the work you're doing. You've done incredible work over the last couple of years, and the emerging fund manager community owes a lot to the work you've done, Joel. So thank you for having me on, and it's an honor to collaborate.
Absolutely. Yeah, honor's mine.
Awesome. Well, yeah, so I think, you kind of asked a little bit about origins. I think for me, my entryway really into what I'm doing now began really early. My mother was the first woman in her family to immigrate to the U.S. from Mexico. And as you can imagine, as a woman, person of color, who only had a middle school education, she had to drop out in the 6th grade to support her family in Mexico. For her coming to the U.S. in the 80s, it wasn't exactly a golden ticket to corporate America. So the way that she provided for us growing up was through entrepreneurship. She always was involved in her own small businesses. Watching her journey gave me two things. One, gave me a desire to be like her. I didn't know what it was at the time, but to be a builder, to be an entrepreneur. So I always knew I wanted to be that. And then two,
sure,
it gave me a passion for empowering underrepresented people in these kind of entrepreneurial spaces. So that's been my North Star my whole career. I grew up in Fort Worth, Texas, and I come from a low-income background. And so, you asked about, like, what did I want to be when I was growing up? To be totally honest with you, I didn't know. Not almost anyone around me went to college or anything like that. But I knew I was going to because of my mom. I knew that even before I knew what college was, like as soon as I think I became cognizant of what college was, I knew I was going to go because of my mom. And so all I knew was, okay, go get an education. So that was just what I knew. I early on loved technology and computers. And so I knew I wanted to do something in technology. I ended up doing this kind of special degree at Texas A&M University, where I studied both computer science and business. If it felt like the right combo for someone that was an aspiring entrepreneur. And I ended up graduating and getting my start in a kind of entrepreneurship that I now actually invest in, which is known as entrepreneurship through acquisition. Another term for it is search funds. So my first real job out of college was actually at a search fund acquired company. So I joined shortly after the search fund got kind of launched and started and began acquiring. So that was my first foray into entrepreneurship and really what I'm doing now, which is investing in these kind of vehicles. So that's my first job out of college. I loved it. Got excited about some of the finance side because we were looking at raising capital, doing M&A deals, etc. Ended up leaving the kind of operating search fund land to enter investing. I helped launch an early stage VC firm. We successfully raised a fund one. We were at the time the only 100% Black and Hispanic owned VC firm in Texas, which is just an awesome journey. Love the team there. I'm still very close. I'm an advisor to the fund there. I ended up getting accepted to grad school. So I was admitted to this joint degree program where I got as you mentioned, my MBA from Stanford and my master's in public administration from Harvard Kennedy School. And so it felt like a good time to pivot. So it's actually COVID. So I deferred for about a year, 2 years. And in that kind of deferral period, I worked in software private equity, did lower middle market buyout, which kind of rounded out my skill set in some ways. After that, went to grad school. Loved that experience. As you probably already know, Joel, Stanford and Harvard are kind of like, they're like the mecca for search funds. The model was created there. The primary courses are taught there. The vast majority of at least historic searchers, search fund entrepreneurs, they come from these two schools. Thankfully, it's now expanding beyond that, but that's kind of where it all began. And so going there really reignited my excitement around this space. I did a little bit of time on the fund of funds side. I worked for a prominent Silicon Valley family doing fund of funds investing in their kind of multifamily office where they manage the capital of Silicon Valley families, but also institutions, endowments, etc. I worked on the PE and VC fund of funds team, which is an incredible experience. It's one thing to work at one fund and, learn that motion or learn that strategy really well. It's another thing entirely to zoom out and look at 100 funds and see what are the common variables of those that perform well and those that don't perform. So it was an incredible experience. Really got to see investing from the top to bottom and give me the kind of confidence to build something on my own, launch my own investment firm. And so and then me and my co-founder, Julian Hamying, who I went to Stanford with. He Stanford MBA, Yale for his undergrad, and then had a very traditional finance background. So JP Morgan, investment banking on Wall Street, and then TPG, private equity, healthcare buyouts, kind of what he did before grad school. And so we ended up going together at Stanford, becoming fast friends, and we knew we wanted to do something together. So during our time there at Stanford, we threw around a lot of ideas over the years and ended up being really excited about the impact we can have in this particular space. And so we ended up partnering together, and with the backing and support of our professors, both financially and just as advisors, ended up launching Mosaic ETA, which is the investment firm we run now. It's a lower middle market private equity firm that invests in companies acquired by underserved search fund entrepreneurs. So that's women, people of color, and people from low income backgrounds who are going out and acquiring companies. So that's kind of a little bit of the background, and weave my story into it a little bit.
Sure. Well, that's great. I mean, you covered a lot of topics, and I think there's a couple that I can zero in on. So you're right. I mean, even for me, thinking about search funds, I think about, this is what the Harvard grads or the Wharton grads do. They go out and they go out and try to find a business to buy. And it's been interesting too to see people share more knowledge about this on the internet. So Cody Sanchez has kind of been doing a little spin on this in terms of buying boring businesses. Where do you think that is going in terms of helping people build more awareness? I think, do you feel like a lot more entrepreneurs and even fund managers can just educate LPs and other founders through social channels? Do you think that's a good modality to do that? Because it seems like Cody's doing a pretty good job doing that.
Yeah, I definitely think, well, I'll say two things. One, I think it's great that more people are pursuing this path because it's a very unique one. And historically, only a select few could have done it or even were aware of it. So I think it's good that more people know about it, because I think ultimately, hey, if you're a great leader and you're very gritty and you have the risk tolerance, this could be a good path. And I don't think you have to have gone to, Harvard, Wharton, whatever school it might be per se. So I do think the kind of expansion of access to this career path is good. I do think at the same time, it's not easy. And you ask anyone who's done it, and it's really, really hard, actually. Most people, if they knew what was on the other side of the acquisition, would just stay at the W-2. They would say, no way. The heartache, the risk, this can go to zero, especially if you're doing it kind of the way that I think Cody Sanchez kind of encourages is more the kind of self-funded route where you kind of go buy a company, you take out some SBA debt. And we think that's awesome for a lot of reasons. The tough part is that you often have to take out a personal guarantee. So if it goes to zero, you're personal liability is incredibly high.
Sure.
And going about it alone, like I think we've all heard stories of doing diligence on a company and you miss something. You're like, oh my gosh, I didn't know that I had to diligence this thing, the medical
Yeah.
codes or this tax thing. And what happens if you're doing diligence alone, right?
Mm-hmm.
The risks of you buying something that ends up kind of blowing up are just higher. It's not
Sure.
a guarantee that it's going to go poorly, but I would say good overall, but you have to proceed with caution.
Yeah, I would say too. I mean, just me thinking about it, I've thought about looking into it, and you're essentially, in some instances, kind of giving yourself just a new job, right? Because let's say you're buying a laundromat, right? Like she kind of shares, you're essentially just, managing a laundromat now, and if you're making six figures at JP Morgan, and now you're like, oh, I'm going to be an entrepreneur, I'm going to be my own boss. Like you're your own boss, but you're also self-employed. So you're actually going into the laundromat and changing the laundromat out and actually operating. So I feel like some people don't see that side of it, which is not as sexy. And you might have to do that in the beginning to really learn the business. And then eventually when you get it to a certain amount of revenue, maybe you can hire an operator to come in and be plugged in. And, I'd say also you want to build a good relationship with the founder. One thing she does mention, I'm reading her book, and I was just kind of intrigued. So there was one piece that I thought was kind of interesting where I think it's kind of like a payback strategy where, like, you come in, you do creative financing, and like the founder will give you some, they'll let you run the business. And then what they'll do is, let's say they're making 10 grand a month in profit, they just get a distribution of that and then you keep the rest. So they're paying you back through just kind of the distributions of the business versus, them giving you a loan or versus you having to put money down. So, that's kind of my limited knowledge of it. But maybe you can unpack the space and how you guys are filtering and screening these opportunities, just so people can kind of get a more detailed lens into kind of how experts do ETA.
Yeah, no, happy to share. And, and I am just thankful that, around Mosaic, we have a group of advisors, both limited partners and just advisors to the firm that have invested collectively in over 300 search funds over their lifetimes and, over 200 operating companies. So this is from, Eduardo's experience, but also very thankful for the men and women who've been supportive of our journey and been pouring into us expertise wise. So I'll kind of give you the super high level on it. There's almost two main forms of entrepreneurship through acquisition. Now I'm simplifying, but in general, there's the self-funded search world, which is kind of what Cody Sanchez and and many others talk to. Then there's a lot of awesome experts. Rick and Royce at Harvard Business School are kind of like they wrote the first really book on this called How to Buy a Business or How to Buy a Small Business. Harvard Business Review, highly recommend it. And then there's that world where it's kind of generally speaking, you're doing it alone and you're buying a company using a lot of debt, kind of generally. And then there's this other world, which is what they call traditional search fund world. And this is where Mosaic mostly focuses on. We also do some self-funded investing, but we do mostly traditional. This is where you're a really talented operator. Joel, you just finished business school and you're like, okay, I have had some good experiences. I want to go be CEO. I just got my MBA. You'll go, Joel, to meet a couple investors and raise what's called a search fund, this kind of initial tranche of capital, typically about $500,000. And that $500,000 you'll raise from about 10 individuals, and you'll use that money over the course of 2 years to search for a business. Once you find that business, month 22, you found a business, you got it under LOI, you're about to close. At this point in time, you've been talking to your investors about this deal, and they have the opportunity, they have the right, but not the obligation to invest in this deal because of them funding your initial search vehicle, if you will. And so then we, typically invest at that phase as well. And what that looks like is generally these companies that we're investing in are somewhere between 10 and 20 million in enterprise value. And we buy, not only, quote unquote, boring businesses, but what we would call enduringly profitable businesses. So companies that have been profitable for a long time and have a high quality of revenue, a high quality of EBITDA. Maybe they're not unicorns. They're not growing year over year. That's venture capital. That's not what I do anymore. This is, hey, they've been growing 5%. They've been growing maybe 15%, and this founder of it is ready to retire. And so that our CEO, young Black woman, Latina from Wharton comes in and is really hardworking, has had a great background, and is ready to put in a couple of years of her life to grow this company. That's kind of how it works for us. In
Yeah.
terms of like screening, I think we look for, a couple of things on, as you can imagine, we kind of have this criteria both for the searcher, the kind of operator we look for, and then the operating company. But in general, we're looking for, the biggest thing for us is it's being gritty. It's kind of the grit factor. Ultimately, you might be buying a company of a lot of, blue collar employees, and you might have to go in there and do some plumbing of the toilets as well. And if that feels anathema to you, then this might not be a good fit. You have to be willing to do whatever it takes
Yeah.
to have business survive. So grit is really number one for us. Two, a history of leadership. Ultimately, you have to, when you buy that company, day one, Joel, you have to go in there and be like, hey, I'm honored to be your leader now. And let's
Yeah.
work together. And if you can't really get that confidence of the employee base, that's going to be really hard. And then, of course, we look at further things like, what is your professional track record? Where have you worked? What have you worked on? Where do you go to school? Who all investors are backing you? Just kind of general, I would say, not too dissimilar from what a private equity headhunter would look for, or a venture capital investor would look for in their CEO. So we just want really, really high caliber people doing this path. And then on the portfolio company, it's like, that's just really straightforward. 10 to $20 million in EV, at least 1.5 million in EBITDA, low customer concentration, high recurring revenue, recession resilient businesses, non-cyclical, kind of the typical lower middle market kind of profiles what we look for.
Got it. And what are some other creative strategies that you've seen for getting funding? So, I mean, we have the buyback thing, we have seller financing. Obviously people can go out and get a business loan, but what are some other, and then SBA, maybe you can unpack how SBA loans work. I mean, SBAs are obviously, tied to a personal guarantee. But what are some other structures that you've seen over the years for enabling more people to buy these businesses?
That's a really good question. I think, the major categories would be, also, Joel, how's my internet? Is it pretty good?
You're
Am I
good.
lagging at all? Okay.
No, you're fine. Yeah, you're good.
Awesome. Just making sure. So I think the kind of main paths are, one, the traditional search fund way. So you kind of go get an initial group of backers, and they will back the deal. So that's kind of the most, common maybe, or the what's most traditionally associated with search funds is kind of this method of a group of private equity firms and previous operators who are excited about creating this next generation of search for entrepreneurs. So that's kind of number one.
Yeah.
Number two, and this is a lot of people, and this is awesome. If you have the money yourself, that's great. Put in 50% of it being your own capital, and then you're buying a $5 million business. You put in 2.5, and the rest is in debt, or it's in a seller note, or whatever it might be. So a lot of people are maybe leaving private equity after 10, 20 years, and they have their own capital. That's great too. Three is, to your point, SBA loans, we think are quite powerful. It's no non-SBA lender is going to be able to beat those terms, really, at least collectively, right? They are favorable terms both in the economics of the deal, so like interest rate, etc., the terms of the deal, so covenants, things like that. It's just the whole package that is the SBA loan is pretty unmatched, I would say, in the traditional private markets that aren't government backed. And then to your point, there can be some interesting ideas around the edges. So if you have a seller who is, for whatever reason, really is willing to work with you, and he's willing to, or she's willing to put up a seller note for a large percentage of the deal, and they're like, hey, you know what? I believe in this. I want to roll 25% of equity, and I'm willing to do a 30% seller note. You only got to put in 45% equity, or maybe it's 20% equity and 30% debt. So there's ways you can get creative, but it ultimately comes down to what is amenable to the seller, right? Because if they're not willing to sell to you, there's no company to acquire.
Sure. What are some of the sectors that you're really excited about? So are they still the boring businesses, or are they the small SaaS companies? Are there certain areas that you think are just exciting to invest in? I'm assuming, software has a lower level of capital intensivity than, maybe a medical device company. But you and your network of advisors are who I'd look up to to learn that.
Yeah, that's a good question. I think the really exciting industries are only obvious in hindsight.
Okay.
It's a little bit like venture, but probably less extreme. And you don't need to, but the best outcomes are when it's a little bit of a contrarian view.
Interesting. I would think like accounting firms are great because you always have to. I mean, I always think when it comes to these kind of businesses, it's like the essential services businesses, right? Things that you always need and that you will always pay for, right? So you always need to go to the doctor. You always need elderly care, right? People are always going to die. Trying to think what else there is, right? So I mean, just logistics, accounting, right? Like everyone always has to do their taxes.
Right.
And then you can expand to kind of like what Carter did, expand to fund admin and expand to other verticals. But that seems like it's less of what's true, I'm assuming. So give me an example of like a kind of a contrarian, opportunity.
Yeah. Well, let me caveat that by saying within the guardrails of what is search fund investing, which is at the end of the day, enduringly profitable businesses with, they're sticky, they're critical. So within the guidelines of the kind of buy box, being contrarian within that buy box is the key.
Yeah.
So to give you an example, I want to be that searcher who acquired an HVAC company 15 years ago.
Got it. Yeah, so you think it's kind of crowded now?
Yeah, HVAC is for sure.
Okay.
Doesn't mean there's not good deals to be found, right? But it's just when the literal Wall Street Journal is putting an article about why you should buy an HVAC business.
Yeah, then it's too late. That's like VC. That's what you mean by it's like VC, right?
Yeah.
So,
and so
once something's published on TechCrunch, that is too late.
Exactly. So this kind of contrarian view within the buy box. I'll give you one interesting example. There, it's very niche. It's recent. There was this searcher. I'm forgetting his name. I think he was out of Harvard Business School, but he did a music school roll up. Turns out, an incredibly great business, but no one knew it before him. Right? No one really thought about music schools, teaching piano lessons, singing lessons as a great opportunity. But turns out, they're all kind of built the same, so it's really easy to exercise synergies and consolidation. The owners of these businesses, they don't like the admin stuff. They want to teach music, and so you're able to come alongside them as a searcher and really do all the business stuff. Buy the company, majority buyout. The owner operator stays on as the teacher, which is what he really wanted, or she would really wanted to always do. And so that's an example of like that was really exciting. Now it's becoming more of a thing. Now there's podcast episodes about how he did it, and now it's percolating, and now there's a couple of dedicated searchers doing the music school roll up. So it quickly becomes crowded in this space.
Yeah.
So I would say that's the kind of best scenario where you can find the kind of contrarian view within the stack. But in general, I would say the businesses we're generally excited about are exactly what you mentioned. Business to business services are just very high quality businesses that have recurring revenue and oftentimes opportunity for cross sell and upsell. To your point, in healthcare generally, as you're, people are continue to get sick and need help, and some people can continue to get old and they need help. And so these businesses that we know are going to have a really long secular tailwind behind them, things we're excited about. Of course, things that are like asset light software, things like that, we're excited about. But that's a little bit mitigated, or at least countervailing force would be those are attractive not just to us, but to everyone. And so like software right now, it's really hard. I would say probably like, I don't know, a couple years ago, maybe 1/5 of one half of searchers were like mainly or at least partially focusing on software acquisitions. That number has dropped significantly. It's probably like 1/4 or 1/5 because the multiples there are so high now, and it's so competitive to buy a small SaaS, micro SaaS company that I think it's income in waves, but that doesn't mean SaaS isn't attractive. The fundamental characteristics is just that the multiples are higher now, which makes it a little bit less sense making.
Sure. No, that's helpful. Tell me some things that you learned in your LP role. Because it's interesting kind of working for a family office and, and diligencing things at scale. It's one thing when you're running your own fund and you've got like a couple companies that you're diligencing. The other companies are in the different phases where you're sourcing and screening them. But what are some things that you learned maybe as an LP, and then just as you talk to all these different family offices, what are some learnings that you're hearing from them in terms of how they think about asset allocation?
Yeah, that's a great question. Yeah, love my time. Is at Jasper Ridge Partners, incredible firm, excellent people. My boss, Pamela Papkov, best boss I ever had. So love my time there. I learned a lot from her and from the team there. Yeah, I think maybe some of my, I learned so much. So I'll kind of maybe share one or two interesting ones. One, there is a weird paradox in the LP world, and Joel, you probably know this as well as I do,
Mm-hmm.
where emerging managers, fund 1, 2, 3, have historically are correlated with higher returns than later vintages. If you look at Cambridge Associates and the top 10 outperforming funds in any given year, something like half of them are always going to be emerging funds. There's something about being a small first time fund 1, 2, or 3 that makes returns better. Maybe it's because you have more to lose. Maybe it's because you don't have a lot of management fee, so you're really working for the carry. I don't know. It's hard to tease out the exact reason why
Mm-hmm.
emerging managers outperform, but they do. And one thing that I realized working at such a large institution, we had 30 billion plus AUM, is it's really hard to allocate to
Yeah.
smaller managers, and
Mm-hmm.
it's paradoxical in that that's where if you can do that well, you will probably have better returns than investing in the next vintage of, insert big fund name here. I don't want to call out any names, but instead of being in that mega buyout fund, in that $5 billion VC fund, if you could allocate capital to a smaller fund, you would probably outperform if you do that well. And so that was one interesting observation of mine where I'm like, wow, there's a whole world kind of that's a little too small where a lot of alpha can be found. And
Mm-hmm.
that's really interesting to me. If I,
Yeah.
in another world, I would launch an emerging fund of funds, because I do think there's so much alpha there. It's so competitive, and like it's always hard to pick, but it's not like there's like a billion of them a year. It's not like
Mm-hmm.
startups. There's like a million people raising capital. There's only a couple of managers every year doing emerging funds. So
Yeah.
all that universe wouldn't be that hard. So that's one interesting thing. I would encourage all LPs listening, figure out what can you do about an emerging manager program, because there's
Mm-hmm.
alpha there, and that's something that
Sure.
it's harder to do when you're bigger. So that's one. I'll pause there. Any reaction to that, Joel? Anything that you've seen?
No, I mean, I hear larger LPs say this all the time. I mean, the only way you're going to really get a 5x on your capital at some point is really through a smaller fund. Maybe a sub 50 fund. Once you get to a couple hundred million, it's going to be really tough to get those multiples back. And then you're better off just maybe investing in like a pension fund, or a retirement style type of endowment style fund, right? So.
Yeah.
I've also seen, so there's a manager that I know. This person worked at one of the biggest universities' private equity programs, and it was what's interesting is with these larger universities, like they have an open-ended model. That's the endowment model. So I've seen managers kind of structure, funds now into an endowment. It's a little different than an evergreen. It's not the same thing, but I thought that's innovative. So I don't know if with you being kind of a creative vehicle that is super practical, right? Like, hey, let's just invest in companies that are making money. What are some other creative types of vehicles that you've seen, in your time as an LP?
Yeah, that's a good question. Saw a lot of interesting ones. I think some of the ones that got me. So as you can imagine, we've really built Mosaic based on a lot of what I saw and what I saw be
Yeah.
best practice. I think I'm really, I really got enamored at Jasper Ridge with the idea of having a fund whose LPs are part of the value add.
Mm-hmm.
Most funds look at LPs as just capital,
Yeah.
and that's great because that's a lot of what LPs do. But what if you had at least a portion of your LPs, maybe all of them, maybe just a portion, that actually ended up being value additive to the firm's activities, to their investing
Mm-hmm.
activities? That's what we
Sure.
ended up doing at Mosaic. And my first inspiration for this was Fifth Wall. Fifth Wall is a VC firm, and
Mm-hmm.
their LPs are corporations. So Fifth Wall does like basically real estate, prop tech type of investing, and some adjacencies there. Well, they have a number now of real estate firms as LPs because they can then be customers of the startups that they back. So when you get a check from Fifth Wall, suddenly you get like 2 customers, right? So I was like, wow, that is genius.
Who are the 2 customers? So the corporation could potentially buy. Yeah, to walk me through the 2 customers.
Yeah. In their example, I'm forgetting their exact customers, or their exact LPs, but Fifth Wall probably has CBRE and Avis Young as LPs in the fund.
Yeah, sure.
Well, CBRE and Avis Young are billion-dollar real estate firms, and the next startup who's working that Fifth Wall, the VC firm, invests in,
they could be a customer. Yeah, so it's both a customer acquisition strategy plus a strategic investment for CBRE, because CBRE wants to kind of strategically invest in companies that are adding value to CBRE. And why not double dip and also sell them CBRE services so you make your money back from selling them? So yeah, just brilliant.
Yep. So I love this idea of, and funds do it different ways, but for us, we many of our LPs are current and previous search fund CEOs. And that's really exciting for the searchers that we back because they get their expertise. They don't just get Eduardo and Julian, which is great. They get 10 now plus, more than that, 20 now plus people who are LPs in Mosaic that support them on their searching journey and their operating journey. So that's an interesting one that I saw. There's kind of a there's so many really interesting ones. There's one that I saw that it was buying corporate lines of credit. So it was the fund was structured that they would buy. Banks they don't have to, but they'll have a credit line, a credit revolver. For their companies. Those aren't really that profitable for banks. They like get a couple percentage points. They're kind of annoying to have. They're liability on the balance sheet, and this fund buys those up. They buy those up at a discount, and they service them, and it ends up being profitable for them. So many interesting strategies out there. I love the emerging fund manager world. There's so many ways to invest interestingly, and the Jet certainly saw a lot of those.
Yeah, I've seen litigation finance. I've seen franchises. I've seen somebody buying robots to 3D print homes. So that's kind of the exciting part about asset management. You're essentially just it's the old historical concept of just taking capital and making more money, right? And there's so many different strategies, and there's so many pros and cons with all the different strategies, right? When you think about venture, hey, that's the only asset where we can get massive outsized returns, but it takes now like 10 to 15 years, to make your money back. Or you could get a 3x, but you need a lot more capital, right? That's private equity. And then I would say ETA, and walk me through the portfolio, the mechanics of the deal. So when you're buying a company, can you share a little more about the ownership and kind of the check size?
Yeah, totally. So the whole end-to-end process is, we give, the searcher from, whatever business school, we give them $50K, 10% equity stake out of the total $500K they're going to raise for that search vehicle. So, okay, Mosaic invests $50K. 2 years later, we've been supporting them every step of the way for those 2 years. They buy a company. Let's say it's $20 million in enterprise value. And let's just say for this example, let's just say it's 100% equity, no debt. So now we get the pro rata right to invest at that same percentage. So we'll write a $2 million check into this portfolio company. They'll become a CEO, and they will run it. We might sit on the board, and the economics are part of what makes the model so powerful is that the economics are really aligned for all the players. So a lot of people ask me, what's in it for the searcher? Why are they pursuing this path? If Eduardo's buying the company plus other investors, what does the searcher get? Well, I think it's 2 things. One, you get to be CEO at a young age, and you learn really fast with a team of people supporting you that have been CEOs or investors before. And then 2, for the searcher, their equity vests in the company as well. So it invests in typically, and there's some variation here, but generally speaking, the searcher CEO who found the company didn't put any money in, they're putting in their sweat equity. They can earn up to 25% of the company, max 30% of the company. And their equity vests in 3 tranches. The first tranche upon acquisition. So once they find that company, we'll just say for the simplicity of numbers, immediately 10% of their equity vest in that company. The
Mm-hmm.
next best is over time. So over 4 to 5 years, now they own 20%.
Yeah.
And then the last 10% vests on performance. So if they return, in this case, a 35% IRR, then their equity becomes 30% of the company is what the searcher owns. So you can imagine if you bought a $20 million company EV, you took it to 100 million, you own 30% of that. That's a pretty good deal. So obviously, it doesn't always happen, but that's kind of how the mechanics work.
Yeah. Well, hey, Eduardo, this was amazing. Let me ask you one more thing, so we can share this with the community. Give me a piece of advice that you would share with other people looking to, number one, get into asset management, private equity, and then maybe also for those that want to eventually launch their own fund. What would you advise them?
Yeah, I would say for those that want to break in, I would say try before you buy. It's not for everyone.
Mm-hmm.
And it seems really sexy on the outside, like anything else does. And the reality is a little less shiny. It doesn't mean it's a bad thing, but I would say, hey, before you commit your life to it or you do all these things to kind of quote unquote break
Mm-hmm.
in, intern somewhere, work part-time, do something, because for a lot of people, a lot of people I think get attracted to the money dimension of asset management, but there's easier ways to make money that are more fun. So if you don't love the business, you don't love what you're actually doing, there's someone in this space that does, which means
Mm-hmm.
they're going to win. And so I think you
Sure.
just have to make sure you actually love what you're doing. It's what I would say anyone trying to break in. Anyone who's thinking about like emerging fund, becoming a emerging fund manager, I would say maybe it's not dissimilar advice, but what's that alpha?
Yeah.
What's that thing that you can do? Like search funds for us, it was the thing.
Mm-hmm.
We have a mission focus on our fund, as you know, Joel. We invest in women, people of color, and people from low income backgrounds. We're the first ones to do it. So that was our
Mm-hmm.
angle. This asset class is really small, search funds. So we had a differentiated view, a differentiated strategy. And if you could do that and be an emerging fund manager, then I think there's promise. You don't want to be like that VC firm that has no alpha trying to raise a VC fund. Like it's no fun for
Yeah.
you. It's not going to be no fun
Sure.
for your LPs. Just find the alpha. What's that alpha for you?
Yeah, no, it's helpful. Well, hey, Eduardo, I really appreciate all your time. You shared a lot of wisdom, and I think the community is going to really value this because we don't talk to too many search funds. So really excited to talk to you and learn from not only your knowledge but also just the valuable ecosystem that you've built around you.
Thanks so much, Joe. Appreciate your time.
Absolutely. Take care and goodbye to everybody else too, and see you on the next show.
See you guys.
Bye, guys.